great unwind. Our Fed's a central bank to a deeply troubled nation. If they sell off bonds, the markets tank. If not, someday inflation. Now the money has been flying, but could the Fed be flying blind? That's why I'm worrying about the great unwind.
Hello students and welcome back. This is Professor Watts, and today we are going to talk about the evolution of the Federal Reserve from its modest beginnings as a decentralized central bank focusing merely on being a lender of last resort and providing emergency currency to the American financial system, to a supporter of government borrowing, a sole issuer of United States currency, and eventually the shepherd of America's macroeconomic stability. So I want to set this up by focusing first on what textbooks say about what central banks do in general and what the Federal Reserve does in particular. Quote, "Because money can affect many economic variables that are important to the well-being of our economy, politicians and policymakers throughout the world care about the conduct of monetary policy, the management of money and interest rates. The organization responsible for the conduct of the nation's monetary policy is the central bank. The United States Central Bank is the Federal Reserve System, the Fed." End quote. So in other words, our textbooks generally start off by saying central banks, such as the Federal Reserve, exist to do monetary policy to stabilize the economy. There's this kind of comical portrayal of the heroic functions, the heroic actions of the Federal Reserve intervening in the economy to stabilize the financial system. Well, they aren't too far from the truth. Here's a headline from 2012 from the Atlantic looking back on the previous several years of the financial crisis, recession, and the Fed's response, and you can see what it says here. Ben Bernanke is the hero who saved the global economy. Well, how true is that? I'd like to assess that with reference to a little clip here from a really funny cartoon show from several years back called The Tick.
Let me get this straight. Last night you get abducted by aliens. They take you to the center of the galaxy where you get sucked into a black hole.
Right.
Uh-huh. And then you save the universe.
Yep.
And can you prove any of this?
Oh, well, we're all still here, aren't we?
Yeah, so, I guess we owe you one, Tick.
Yeah, thanks.
Anytime, chums.
So as the Tick said, we're all still here, aren't we? So the Fed did its job. Well, perhaps, but there's a lot more to the story, and there's a lot more detail about what central banks actually do that goes well beyond what most of the textbooks focus on, and that's what I want to focus on here in today's lecture. So the rest of the story and a deeper understanding and appreciation for what the Fed does and what it's set up to do as a central bank and what it has historically done is going to require us to dig into some history, some unique aspects of American financial institutions and banking system, and then a little bit of public choice economics, which is the economic idea that people in the public sphere, people working for government, don't have a different set of interests and motivations than people operating in the private sector of the economy. We're all operating under rational self-interest, and people primarily try to take care of themselves, their friends, their interest groups they belong to first, rather than necessarily acting towards the good of the whole, the good of the general public. So there's more to the Fed and central banks than just doing monetary policy for the good of us all. When it comes to why was the Fed created, well, it was largely at the behest of bankers in the United States. Bankers asked the government to create a central bank, which is, if you recall from the previous lecture, this is pretty unique in world history because most central banks were either created by the government itself for the government or were government kind of takeovers or acquisitions of pre-existing banks. The Fed was created synthetically by the government for the banks. What is it? Well, it started off strictly as a reserve monopolist central bank, a bank that would pool a large volume of the reserves of the banking system and then have those available to make loans to member banks, who would be the commercial banks pre-existing in the country, and they could borrow from the Fed when they were short on reserves, when they were short on liquidity, when they needed money. The debate started in about 1890. Finally, the Fed emerged when the opportunity presented itself in the aftermath of the Panic of 1907. Jekyll Island, Georgia, was kind of a resort area off the coast for the wealthy elites of the time. There was a small cabal led by J.P. Morgan, the banker, his associates, where they got together and planned and plotted the institution that would ultimately take shape as the Federal Reserve. Why did the bankers get together and scheme and design a central bank institution, promote various proposals in the United States Congress to get this created? Well, previous regulations under the national banking system, which was created during the Civil War, had caused serious harm to the American banking system's ability to provide currency. And in the 1800s, currency was very important, probably more important than it is now, because today we have electronic payment systems. We can buy things online, we can transfer money online, we can use debit cards. Currency is still pretty important, but not nearly as important as it was then. Currency was the main vehicle of trade and payment then, and there were noted seasonal fluctuations in the economy's need for currency. And as I mentioned before, the bond collateral requirements for national banks to issue currency, they had to buy government bonds as collateral or security for the currency they issued, made it very difficult for national banks to do so, especially in the later years of the 1800s. As the government debt dwindled, government bonds became less available and more expensive. We had a serious problem with the currency. The currency situation was known as inelastic. In other words, it couldn't stretch and adapt to meet the needs of commerce at any point in time. Free market voices who advocated for the ability of banks to issue their own currency, but just secured by their own assets, which is a feature of a free banking type system, were generally eclipsed by the progressive voices who looked for a centralized government solution to most problems in society. However, there were still in the United States high suspicions of centralized institutions. I won't go all the way back to Thomas Jefferson and the early Democrats. So to create a central bank, a pure central bank on the European model, was still a pretty difficult sell. So the compromise that was reached was to create a decentralized central bank that consisted of 12 regionally based, relatively autonomous branches, autonomous and equal branches of a system, the Federal Reserve System, that could centralize the reserves on a localized basis and then provide lending and meet liquidity needs of their constituent member banks on a more localized or decentralized basis. It was also designed to respect the operation of the international gold standard. The United States had formalized the gold standard in 1900, and as of 1913, basically the entire industrialized world, all the advanced economies of the world, were formally on the gold standard. So this was part of an international monetary order, and it was already by then well recognized for providing stability. The Fed initially was only to issue emergency currency. It was not there to create a new kind of money for the entire economy, but rather a supplement for the inelasticity of the previously existing monetary system and currency. And the Fed also was designed to adhere to classic central banking doctrine. Bagehot's rule, we've mentioned Walter Bagehot before, the founder of The Economist, one of the great financial news sources in the world, and a keen observer of the Bank of England. And Bagehot's rule states that central banks should lend freely to banks in their system in times of crisis, in times of illiquidity, but only to solvent banks. So only to banks that have illiquidity problems, not banks that have insolvency problems. And they should lend to those banks at a penalty rate. In other words, it should be the lender of last resort, not the lender of first resort. The central bank encourages banks that are illiquid to borrow funds from other financial institutions and only come to the central bank if they are unable to get funds from other sources. So lend freely at a penalty rate to solvent but illiquid institutions. That's summary of Bagehot's rule, and that's how the Fed was initially established. Here are some of the main personages who were pushing for the advent of the Federal Reserve. J.P. Morgan was the most important financier in America at the time. President of J.P. Morgan and Company. Of course, that's a predecessor to today's J.P. Morgan Chase, which is America's largest bank still today. Morgan was at the head of the coalition of bankers who favored the adoption of the Federal Reserve. He was the leader of the Jekyll Island Party that got together and basically drafted the blueprints for what would become the Federal Reserve Bill. Another very important banker was the German immigrant Paul Warburg, who was with the investment banking firm Kuhn, Loeb and Company. That firm was a predecessor of the probably well-known Lehman Brothers Investment Bank, which was one of the casualties of the financial crisis of 2008. But Warburg was an advocate of European-style central banking in America. He viewed the American economy as too decentralized and too fractured, and he thought a central bank along European lines could help provide a uniform and elastic currency. And just to mention one other of the major people involved was Senator Nelson Aldrich of Rhode Island, who was chairman of the Senate Finance Committee, and as such, the most influential person in Congress regarding adoption of new financial regulations or new government-based financial legislation. Okay, so what is the Fed? Well, we've talked about this briefly. It's a decentralized central bank that was initially created to centralize reserves in the banking system and issue emergency currency. And as you can see from this contemporary news clipping from 1913, here's President Wilson. It says President's signature enacts currency law. It wasn't even necessarily billed as a central bank institution because it wasn't a central bank in the sense that we've seen it in other countries. It was more of an institution that would be able to supply banks with currency as needed to overcome the inelasticity of the previous currency regime under the national banking system. And the Federal Reserve at the beginning was able to issue the Federal Reserve note, which we know today as is ubiquitous as the form of the dollar. But back then it was just one additional way of making dollars available to the public. A few more words about this currency situation. The Monetary Commission of the Indianapolis Monetary Convention, which took place in 1897, and this was largely a group of scholars who got together to discuss monetary problems in the United States and what should be done about them. And the summary of that report of the National Monetary Commission lists 8 points that reform should accomplish. Point 4 here, which I'll zoom in on, as the most important, it says to provide a paper currency convertible into gold and equal to it in value at all times and places in which, with the volume adequate to the general and usual needs of business, there shall be combined a quality of growth and elasticity, through which it will adjust itself automatically and promptly to all variations of demand, whether sudden or gradual, and which shall distribute itself throughout the country as the wants of different sections may require. So there were 2 schools of thought at the time, circa 1900, as to how this might be accomplished. One was basically the free banking school, or at the time was known as the asset currency movement, which said just let banks issue their own banknotes, and as people need more currency, banks can issue it, and as people don't need it, they'll send it back to banks, they'll deposit it, and then it'll be extinguished. So you could have an automatic adjustment process through the free banking mechanism. The other school of thought was that that would be that free banking was unreliable, it wouldn't be uniform, the currency wouldn't be trusted, it might trade at different prices in different parts of the country, and so what was needed was centralization through some kind of government-sponsored banking enterprise or a central bank. Needless to say, the central banking forces won out, and that's why we're going to get the Federal Reserve established as of 1913. Now, as I've mentioned, the Fed is a decentralized entity, so you have 12 branches ultimately located throughout the country at what were at the time some of the more important financial centers as of 1913. Okay, now why? Let's talk more about what was going on in the United States at the time and why there was this perceived need for a central banking institution. Well, here's some images of the bank runs associated with financial panics that occurred somewhat routinely in the late 1800s, early 1900s. 1873, 1883, 1893, 1907. So there were several major financial panic episodes, often started as liquidity problems. Certain banks in certain parts of the country just ran low on reserves and sometimes emerged into a full-scale financial crisis where credit got shut down, interest rates spiked, banks found it difficult, if not impossible, to access funding, and that could lead to some banking shutdowns, that could lead to a cessation of credit and lending, and that could lead to an economic downturn. And that happened on a few occasions, and the economy could go into recession, if not depression, and that was viewed as needless because it all stemmed from the financial system just not being able to supply the liquidity or the currency to meet the demands of businesses and the public. These episodes created kind of the public fervor, and especially in the banking system, the clamor to have a superordinate banking institution that could meet these crises. Here's an image that highlights the difficulty with inelastic currency. This is from a study called Monetary Reform and the Redemption of National Banknotes by two great monetary scholars, Selgin and White. Now, we're starting in 1880 and going up to about 1910 or so, and what we're doing is looking at the circulation of banknotes over time, and we're comparing national banknotes here, which is the United States, versus Canada, which was served by, I think, 4 or 5 major nationwide banks. Canadian banknotes, you'll notice, exhibit 2 things. One is the seasonality. So towards the end of every year, the volume of notes increases and then it declines, increase, decline, and that's very regular year by year. And then over time, you also see a gradual uptrend in the total or the average of banknotes in circulation. So what's going on there is that Canadian banks are able to meet the seasonal needs for currency. It's generally associated with the fall harvest season, and they're also able to kind of have a gradual upward drift in the supply of currency over time as the economy grows, as the population grows, as the economy just needs more money to finance all the economic activity without the need for deflation. So this is actually stable in the context of broad economic growth. Okay, so there you see elasticity and seasonality and a well-functioning banking and currency system. In the United States, you see something unlike that. First, you see a decline through the 1880s here. This is largely related to the decline in the availability of government bonds, which were the security required for national banknotes. You don't see a whole lot of seasonality. You really see none. You do see some increases here. There were some stopgap measures that allowed national banks to expand their note circulation kind of on a one-off basis. So you can see a blip upward here. You can see a pretty large upward blip here as there were some measures that allowed the broadening, kind of a one-time broadening of national banknote issuance, but you don't see that seasonality or the cyclicality, and that points to the fact that this is an inelastic currency system compared to that kind of regular, it's almost like a heartbeat of the Canadian system. So Canada has an elastic currency system, America doesn't. That is the problem. Now, how does the Fed operate? The Fed initially operates through making what is known as discount loans through the discount window. Here, this is a picture of me several years back with some of my former students. These were Federal Reserve Challenge competition students, and we are here at the Chicago Fed. And in the Money Museum, they actually have this part of the original Chicago Fed structure, which is known as the discount window. Loans and discounts, and bankers back in the early days of the Fed would actually dispatch somebody from their staff to the Federal Reserve Bank, whether it was the main branch or whether it was the main bank or one of the regional branches, and they would bring a portfolio of loans or discounts, which were a form of short-term commercial loans. They would bring a portfolio of those to the Fed and say, hey, we need some currency. We'd like to borrow some currency. Here's a portfolio of loans that we can pledge to you as collateral. And the Fed would say, okay, we'll loan you, 98% or 95% of the value of those collateral loans, and then the bankers could go home with Federal Reserve notes if they needed currency to supply to their own customers. And that process was known as discounting, or technically rediscounting the loans of the bank. And so the term discount window, that's where it comes from. That was the mechanism by which the Fed would make these emergency, temporary, short-term loans of reserves or currency to its member banks. Nowadays, all of the Fed's lending is done through electronic platforms. The discount window is no longer relevant, but the terminology often sticks, and so you'll sometimes hear people referring to the Fed making discount loans or operating a discount lending facility. Well, that's the Fed supplying banks with loans of reserves and currency, and that's what the Fed was created to do. Okay, so let's just recap because we've covered a lot of ground so far. The Fed was a decentralized central bank. Remember, 12 regional branches that were relatively autonomous and engaged in local policy decisions. Issued emergency currency, Federal Reserve notes, through secured reserve loans to temporarily illiquid but solvent banks. So banks that were otherwise sound, who had a good book of loans, who were earning interest and not seeing excessive defaults on their loans, but for one reason or another just had a drain of their reserves and were unable to supply currency to their customers. It abided by the rules of the International Gold Standard, mainly that bank liabilities would be redeemable for gold for the underlying base money at both the individual bank level and at the central bank level. Well, that's not quite what the Fed does today, and as the old cigarette ads said, you've come a long way, baby. So the Fed has come a long way from its original purposes. Some of this is still done, but most of it is morphed into something that would probably be unrecognizable to the original founders of the Federal Reserve. The Fed today is no longer decentralized, but really centralized in the Washington, D.C. based Board of Governors. And day-to-day operations for monetary policy are centralized at the New York Fed. The Fed has unlimited ability to print and issue US dollars. Of course, we did away with the gold standard many years ago. And instead of being an emergency currency, the Federal Reserve note is now the US dollar. The Fed engages in monetary policy. That wasn't really part of its original charter, although it's almost inevitable that if you create a banking institution with that much power, and especially if you create a banking institution that's going to monopolize money issuance, it's going to have to engage in monetary policy. And the monetary policy mandate was actually imposed on the Fed by Congress in the late 1970s. It's known as a dual mandate of keeping prices and interest rates stable and also promoting a macroeconomic stability with the aim of keeping employment at its maximum sustainable level. Unofficially, the Fed also can be seen as protecting the interests of banks, especially big banks, too big to fail banks, and Wall Street firms, investment firms, and as being what I call a fiscal helper, an entity that supports government borrowing by either purchasing government debt outright or by supporting government debt through various measures, through lending money to financial institutions for the purpose of investing in government debt. So let's put this kind of in a chronological perspective. The Fed begins as a lender of last resort to supply currency to banks suffering from illiquidity. The Fed will evolve next into supporting government debt because historically what happens right after the Fed is created in 1913 is the onset of World War I in 1914. Now, the United States is able to stay out of World War I for the first several years, but by 1917, the United States is a combatant, and that means U.S. government spending is going to explode as the government mobilizes a massive military buildup and sends troops to Europe to fight alongside Britain and France. Similar story is going to happen in World War II, just on a larger scale. So what the Fed is going to do is help the government keep its borrowing costs low by targeting interest rates on government bonds at a very low level. Well, how can a central bank ensure that interest rates stay low? It does that by either directly buying up the assets or by putting money into the system with which various financial institutions can accomplish the same task. So some might call this debt monetization. Some might say, well, the Fed wasn't doing it directly, it was doing it through banks. Either way, the effect is the same. Massive expansions in the money supply in order to ensure that the government has a ready source of funds for its debt-based expansion of spending. And as you might guess, that is going to lead to inflationary episodes in both cases. Quantitative easing that occurred during the financial crisis, and we'll talk more about this in the coming weeks. Is the Fed monetizing government debt again? The answer is basically yes, and sitting here in early 2020 at the cusp of likely a renewed recession given the impact of the coronavirus outbreak, we might be looking at further rounds of quantitative easing and further monetization as the government is looking like it's going to be ramping up spending to a tremendous degree once again. And then finally, we have the advent of monetary policy authority. The Fed actually started this pretty early, kind of on its own, and you could argue outside of its mandate. In the 1920s, the Fed begins performing open market operations and trying to stabilize the price level. After the 1930s banking crises, which we'll talk about here in a moment, the Fed is actually given more power, which is ironic because the Fed had failed to engage in its arguably main function of lender of last resort, and that is what led to the collapse in lending and the money supply that made the Great Depression so severe. We made a final switch from the gold standard to paper money in 1971, and at that point the Fed gained a complete monetary monopoly. So gold used to be the base of the US dollar. That was somewhat true up until 1971. After 1971, when Nixon closed the gold window and we abandoned the gold standard for good.
I'm getting us back on the gold standard!
What is exactly this golden standard?
It's the monetary system where paper money got value directly related to gold, you dummies. You tell me a dollar is worth 25 8/10 grains of gold, we all know what's what. But that dirty President Nixon back in 71 unilaterally took the entire country off the standard. And ever since then, we've been based on the dollar value on a freely floating exchange rate. Ah!
The Federal Reserve note now is the US dollar, as I've mentioned. So how did we get from there? The gold standard, price stability, and the Fed as lender of last resort and supplier of emergency currency, to here, where the Fed is engaging in massive monetary expansion. The Fed has a monopoly and complete control of the US dollar and can issue as many new dollars as it wants in the pursuit of monetary policy measures, bailouts, massive loans, and potentially engendering a renewal of large inflation. Let's take a little bit closer look at the Fed's role in the Great Depression. The Fed failed at its primary task of lender of last resort on a massive scale in the Great Depression. We had about 4,000 banks in the U.S. fail, and those bank failures caused a cascading decline of the money supply. By the end of 1933, it was about a 1/3 decline from the peak in 1929. So the Fed was supposed to be the entity that would prevent bank illiquidity from pulling banks under and forcing them to close their doors. And here's a good summary of what happened and what the Fed's role in that was from one of the most popular monetary textbooks, Frederick Mishkin. He says, what might have been a normal recession turned into something far worse, however, when severe droughts in the Midwest led to a sharp decline in agricultural production, the result that farmers could not pay back their bank loans. The resulting defaults on farm mortgages led to large loan losses on bank balance sheets in agricultural regions. The general weakness of the economy and the banks in agricultural regions in particular prompted substantial withdrawals from banks, building to a full-fledged panic in November and December of 1930, with the stock market falling sharply. For more than 2 years, the Fed sat idly by through one bank panic after another, the most severe spate of panics in U.S. history. With a greatly reduced number of financial intermediaries still in business, adverse selection and moral hazard problems intensified even further. Financial markets struggled to channel funds to borrower spenders with productive investment opportunities. The amount of outstanding commercial loans fell by half from 1929 to 1933, and investment spending collapsed, declining by 90% from its 1929 level. The ongoing deflation that accompanied declining economic activity eventually led to a 25% decline in the price level. This deflation short-circuited the normal recovery process that occurs in most recessions. The huge decline in prices triggered a debt deflation in which real net worth fell because of the increased burden of indebtedness borne by firms and households. The decline in net worth and the resulting increase in adverse selection and moral hazard problems in the credit markets led to a prolonged economic contraction in which unemployment rose to 25% of the labor force. The financial crisis of the Great Depression was the worst ever experienced in the United States, which explains why the economic contraction was also the most severe ever experienced by the nation. So the path out of the Great Depression from a monetary perspective, because the Fed was not doing its job of making loans, which it was able to do because it had monopolized the reserves of the banking system, the federal government took it into its own hands under President Franklin Roosevelt to stop the deflation and to put an end to the financial panics by debasing the dollar. And that worked to the extent that deflation stopped and the money supply was able to expand again, and the economy did start to recover after that episode. it's what we would call a positive aggregate demand or positive spending shock, and a return to inflation, which eased the real debt burden and sowed the seed or laid the groundwork for a recovery in GDP growth. So President Roosevelt, when he was elected, he took office in early 1933. He suspended the payment of gold and silver coin from banks, and then about a year later devalued the gold content of the dollar by about 40%. So as you can see here, with respect to both GDP growth and inflation, GDP growth here in red, well, GDP had been declining since this 1929 peak, bottomed out. Roosevelt assumes office here in early 1933, announces the suspension of specie payments and that he's going to devalue the dollar. The devaluation happens in early 1934, and during that time period you see GDP start to grow again, and you see inflation go from what was at its nadir a deflationary rate of minus 12%. So you see some steep deflation. By the time of the devaluation, inflation goes back positive, and it's here in the positive 4 to 5% range, and then generally stays positive for the next several years, although we had another little bit of a dip here in the later 1930s in 1938. That episode is also arguably attributable to the Fed making a policy mistake of increasing banks' reserve ratios, but that's something we'll talk about another day. So you have the Fed basically not knowing what it's doing here in the 1930s, and to avert a total monetary disaster, the government's intervening and devaluing the US dollar. All right, now let's move up to the modern Fed. The 1970s, as we've mentioned, after the gold shock, after the Nixon shock in 1971, we're on a pure paper money system, the Federal Reserve note dollar. Fed has total control of the monetary base, and the Fed's main job becomes monetary policy. Now, the Fed's still doing its lender of last resort function kind of in the background, but monetary policy becomes the forefront of the Fed's activities. The dual mandate, as I mentioned, for price stability and maximum employment is imposed by Congress, because Congress realizes, well, the Fed has total monetary control now, so we better tell them what we want them to do with it. We better give them some formal goals as to what we want them to do with it. And monetary policy then is the province of what's known as the Federal Open Market Committee. The Open Market Committee consists of the 7 members of the Fed's Board of Governors, which is headed up by the chairman of the board, and the 12 presidents of the regional Federal Reserve branches. So let's wrap up. We've covered a lot of ground here. Let's tie it all together. The original, and of course still relevant, purpose of the Fed is that lender of last resort function, first to banks and then, as circumstances demanded, also to the government. Fed saw some miserable failures, particularly the 1930s, the Great Contraction of the money supply and the Great Repression. Also in the 1970s, with the Fed overseeing a period of pretty massive increases in the inflation rate. And arguably also some successes. The Fed arguably kept things pretty stable in the strong growth era of post-World War II, 1950s and 60s. The Great Moderation, after the Fed had brought inflation back down to earth in the early 80s, up through the financial crisis of 2007-2008. Switching from gold to paper money gave the Fed essentially a monopoly of the money supply and put us into an environment of constant inflation, which has generally been low, but as I mentioned, there's been some significant outbreaks of pretty high inflation, such as the 1970s. And then finally, in bailing out too big to fail banks and purchasing government debt, the Fed is just doing what central banks were always designed to do. Central banks were either explicitly founded to make loans to their government, that's pattern 1, or they were existing commercial banks that were basically co-opted by the government to operate for the government's own purposes. That's pattern 2. The Fed was created to make loans to banks, not the government, but it was quickly kind of dragooned into the role of also supporting government spending. So the Fed is somewhat an amalgam of all the different kind of central banking organizations we've seen through history. The upshot of all this is to note that the Fed is the most powerful entity in the United States economy because of its vast powers and influence over money and interest rates, supply of credit, and financing for the government. So that's what we want to keep in mind. We want to keep this historical context of the Fed's evolution and adaptation and successes and failures in mind as we evaluate what the Fed might do going forward.